The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Good morning. Depends on where you are in the world. I've got two wonderful guests here today. I have Tariq Dennison, TEP, who's the wealth manager at GFM Asset Management. He's located over in Hong Kong, so good evening to Tariq. And Eugen Moore, who is a native of Germany and is currently situated in the Chicago office of the Eurex exchange, where he's the Vice President of Equity and Index Sales for the Americas. Welcome, Eugen. We'll speak to Eugen in a moment, who's going to introduce the session. Today's event is being recorded. We're going to look with Tariq at capturing European opportunities with Eurex micro futures. If you can hear me, if you can't hear me, you can still type a Y into the question panel in the GoToWebinar software, just to let me know that you can that you can hear today's presentation. If you have any questions for, thank you, Jacob. Well, Jacob, it's good morning to me. I'm over in New York State. He says, good evening, lads. So today's session is being recorded. You will receive a link in your email approximately 2 hours after the end of the of the live presentation from Tariq. So look out for that. There is a handout in the handouts panel. If you expand the handouts panel in the GoToWebinar software, you'll see a downloadable PDF link that the lads have put together. Good afternoon, Peter. Thank you for joining us. As I say, please post questions into that same chat panel that people are making comments in there now. I am going to put up a slide of disclosures from Interactive Brokers. Please just give that a read and make sure you understand some of the risks that may be addressed in today's presentation. And I think, first of all, we are going to go over to Eugen in Chicago. If Eugen will unmute his phone, and welcome. An early start for you, Eugen.
Yeah, hello, good morning, and thank you, Andrew, for giving us the chance talking about today about our new micro futures. I mean, Eurex micro futures is a complete new thing. We're going to launch them next Monday, April the 19th. It will be 3 micro futures on EURO STOXX 50, the DAX, and SMI. I mean, Tariq is talking a bit later about this on the new products. But yeah, again, thanks for having us, and thank you for giving us the chance to talk about Eurex and about our new product offering. We are very excited about that. We start with the micros. I would like to give a short update about Eurex. I mean, maybe not everybody knows about Eurex, or maybe not everyone is fully aware of Eurex. Eurex is a derivatives exchange based out of Europe, based out of Frankfurt, Germany, and is part of the Deutsche Börse Group. Deutsche Börse Group is one of the top leading exchange providers in the world. And Eurex is the derivatives trading arm of Deutsche Börse Group. Eurex itself, it's a pretty new company, actually. We have been founded, I would say, 30 years ago. Today, you probably would say it's a typical startup. The specific of Eurex is that we started as the first fully electronic exchange trading derivatives. I mean, in the old days, everyone was trading in the pit. I mean, our competitors, CME, SIBO, still have some pits trading ongoing, but Eurex was from day one, so in the early 90s, was the first exchange who had a fully electronic order book, and actually never had a pit trading ongoing. So this was a kind of a pioneer trailblazer from Eurex, and also the system functionality and the system trading design was always a very important piece of Eurex / Deutsche Börse. Therefore, I think this 30 years of experience, we still take advantage out of it, as said, in terms of system latency, reliability of the system, and so on. So that's a little bit of background of Eurex. Eurex itself, as said, we are a derivatives exchange. We are amongst the top 3 derivatives exchanges in the world in terms of open interest and traded contracts. As said, we are out of Europe, so our hub is in Frankfurt. So our focus is mainly on the European asset classes. We have a pretty diversified product portfolio. I mean, our biggest portfolio, or our biggest asset class, is in the equity index space. I mean, here we have our benchmark future, the EURO STOXX, where we also launched the micro future now, and of course also very well known the DAX. So that's our biggest piece in the equity, out of the equity index space. But it's not only equities, it's also fixed income. I mean, Eurex is the home of the European yield curve. So I mean, most of the listeners probably know we have, for example, the Bund future, Bobble future, Schatz future. So covering the whole asset, the whole European yield curve. A couple of years ago, also launched a few fixed income futures on Italian and French government bonds. So as we're trying to cover this whole ecosystem. Then another product which becomes more and more important is volatility, of course. At Eurex we have the VSTOXX. VSTOXX is the volatility index, implied vol on the EURO STOXX 50, covering the implied vols of the EURO STOXX 50 components. VSTOXX, I would say, probably everybody knows the VIX, and VSTOXX would be the European equivalent to the US VIX. What we have become lately also more active is in the FX space. So also here we have a broad spectrum of FX derivatives, but also covering the spot market. A few years ago, we acquired 360T, which is a huge player in the FX space. So as said, I mean, Eurex has a broad spectrum. The product portfolio is pretty diversified, and we are continuously, and I think that's an important thing, we're continuously working on this portfolio and enhancing the portfolio and bringing new products and new trading ideas into the market, following the demand from our clients. I think that's an important thing, and that's something we follow over the past 30 years since we have been founded. Eurex trading is one part, but we are also a clearing house. So I mean, as everyone know, trades that are traded need to be cleared. So we have on the other side, we have the Urex Clearing AG, which is a fully fledged clearing house. It works under the, I think this is a worldwide standard, the CCP standard, so a central counterparty system, which means that all trades that are executed are guaranteed by the exchange. So in case there is a default, as we had it with Lvmh or with MF Global a couple of years ago, the exchange always makes sure that the trade will be delivered, the payment will be the derivatives will be delivered, and the payment will be delivered as well. So this is a second essential part of the exchange. Another important piece, and I think that's also something for the end clients to know. We also have the margining and the risk system in place. At Eurex, it's called Prisma. Prisma is a portfolio-based margin approach. So that means if you have certain positions out of the equity space, out of the fixed income space, there are of course some correlations, and because of this portfolio-based approach, margins will be offsetted, and kind of margin efficiency and capital efficiency, which is important for all the investors, is always guaranteed. Last but not least, before I hand over to Tariq, as said, Eurex is not only an exchange, it's also a kind of software provider. as said, we have been the first fully electronic exchange. So software development, software, yeah, software is one key part of Deutsche Börse Group. So 10 years ago, we launched a new trading platform called T7, and this is kind of state of the art in terms of latency, in terms of reliability, in terms of throughput. And yeah, I mean, over the past years, we had very low number of outages, and the exchange is continuously working on an improvement of the system to guarantee, and that's the most important part of an exchange, fair and orderly trading. Yeah, I would say that's it already from my side on Eurex. And then I would like to hand over to Tariq on our new micro futures.
Okay, just making sure I'm here. I've been made the presenter, show my screen. All right, I think I see my slides there. I'm just going to put it in full mode, full screen mode. There we go. All right, got it. All right, well, thank you very much for that introduction to Urex. Oh, again, I have to admit, every time I listen to that, I learn a little bit more. As mentioned, my name is Tariq Dennison. I'm an independent wealth manager at a firm called GFM Asset Management, based here in Hong Kong, where I've been for 11 years now. This cover photo, in this case, those of you who've attended other webinars of mine know that I always like to start with a colorful cover photo from my own experience. Happens to be at the Greek stock exchange, and today we're going to be talking about the EURO STOXX, the DAX, and SMI. Not really anything to do with Greece, but when I was looking for anything having to do with European exchanges that had a cool picture of me on it, this was the coolest that I got. Today, those three indexes we're going to be talking about specifically are the micro futures. And I'm really going to be going into how I would use them as a wealth manager and as a trader, and how I would use them differently than, say, how I would use an ETF. And I'm going to be listing 4 specific strategies that I would use these futures for, say, in place of an ETF or as part of a portfolio. Now, before I begin, a few important disclaimers. And a disclaimer from Eurex. Now, a little bit about me. As mentioned, my name is Tariq Dennison. I am a TEP, which is a STEP certified trust and estate practitioner. And here in Hong Kong, I'm also a certified financial planner. That means in addition to investing, I help my clients plan their overall wealth plan, estate plan, retirement plan, and so forth. And I run 2 parallel licensed firms that manage investment accounts on the Interactive Brokers platform. So for example, if you have an Interactive Brokers account and don't have the time to manage it, or want to put a more serious amount of money in it, but want to know how to generate income, that is the way that I manage those accounts on the platform. And you can message me afterwards. I'd be happy to tell you details on how we can work with you. In terms of market experience, I've been in the markets since 1998, and I've actually traded EURO STOXX futures since 2003, the big contracts. I started my markets career at Commerzbank in New York, and also spent some time in London and in Frankfurt. And then a good chunk of my career at an investment bank called Bear Stearns in New York, all the way up until it collapsed in 2008. It's taken over by JP Morgan in 2008. After Lehman collapsed, it spat us out with nice big severance packages. I then traveled by train from Turkey to Singapore by train, a good story in its own right, and came out here to Hong Kong 11 years ago with a Canadian bank known as CIBC, the Canadian Imperial Bank of Commerce. I then spent 1 year at Soc Gen, and after that, I left and started my own wealth management firm. I have a master's in financial engineering from the University of California at Berkeley, and as you may be wondering a little bit about my background, yes, I am an American, hence the American accent, but I was born in Italy, I grew up in Germany, and I live out here in Asia by choice. So I very much have a global perspective, and I do very much have a background in Europe that does give me a soft spot in some of those markets there. Adding to my European portfolio, I teach at a French business school in Singapore, 2 classes, fixed income and alternative assets. Those of you who may know ESSEC stands for École Supérieure de Sciences Économiques et Commerciales. My main focus out here, though, really usually doesn't involve Europe, except as a portfolio allocation. I tend to focus on the US-Asia corridor, and I need allocations to Europe, usually either for tactical portfolio positions or to complete overall portfolio allocations. And when I want to allocate to Europe, the EURO STOXX 50 is generally the first index that I look at. If you want to find out a little bit more about my investment thinking, you can see my book, Invest Outside the Box, Understanding Different Asset Classes and Strategies, 11 chapters, and available wherever you get your paper or ebooks. Now, my presentations, those of you who are familiar with my blue and white two-sided presentations, first, I'm going to be outlining a lot of the fundamentals and underlying background of the indexes that we're going to be talking about. So I'm going to start with a very, very brief financial history of Europe, and then I'm going to be diving into what is actually in these indexes that we have futures contracts on. So what is the EURO STOXX 50? What is the DAX? What is the SMI? How do they compare to each other? And how do they compare to a benchmark like Msci Europe? Why would you want to choose one versus the other? How might you put them together, either in a portfolio or in a spread trade? So I really do believe it's important to start with the fundamentals, and I do want to take some time to go through and make sure you understand what these three indexes are. Then I'm going to introduce what are these new micro futures contracts? How are they different than the big or the mini futures contracts you might be familiar with already? And just as importantly, how do you find them on your Interactive Brokers Trader workstation? So I've got actual screenshots of what you're going to type in so that you can find them and actually execute a buy trade, a sell trade, a spread trade, and so forth. Then we were going to talk about those 4 strategies that I promised you. I think there are 4 if I remember my slides correctly. Number 1 is leverage. Number 2 is hedging and shorting. Number 3 is spread trades. And then number 4 is what I call currency optional trades. And this is a form of access which is very important, especially to those of us who allocate to foreign markets and are not based in, say, euros or Swiss francs. I'm going to try my best to go into detail on how each of these strategies work and how you might use them as an investor with an Interactive Brokers account. Now, when it comes to margin offsetting, I would have to defer back to Eugen specifically on that, because I will show you at least the screen that shows you what the margin limits are. But as a wealth manager, I don't go anywhere near those margin limits. Yes, I do find futures contracts to be very capital efficient for leverage and hedging strategies. But if you really want to find out how that margin offsetting works, I will defer back to Eugen on that. Now, the brief economic history of Europe. I once worked with a strategist who said very, very well, you really can only understand the European Union, you can really only understand the euro, you can only understand euro crises if you understand that Europe, as we know it today, was built in stages. And here, of course, when I'm talking about Europe, I'm talking about post-World War II Europe. So first of all, forget everything that happened before 1945 for now. Really where our history of the EURO STOXX begins is in 1957, when the Treaty of Rome established what was the predecessor to the European Union as we know it today. Initially, that was called the European Coal and Steel Community, later the European Economic Community, and then now we know it with the 12-star flag on a blue background as the European Union. Now, that initially you might think that, okay, well, we now have a fixed currency. There actually also was a fixed currency for many of these EU members until 1971 under an agreement called Bretton Woods. Those of you who know your financial history know that from the 1930s until August 15th, 1971, so we will be celebrating the 50th anniversary in a few months, gold was pegged to the US dollar at a rate of 35 US dollars per ounce of gold, and many other major currencies were pegged to the US dollar in turn through that system called Bretton Woods, which collapsed on August 15th, 1971. When that currency peg was abandoned, it meant that many of the separate European currencies, the Deutsche Mark, the French franc, the Italian lira, the Spanish peseta, got to start floating freely. And you can probably guess how the German mark and the Italian lira and so forth floated quite differently. How you had Southern European countries who would very often want to let their currencies weaken in order to stimulate their economies. The German mark often had the problem of being excessively strong. And that was something that persisted from 1971 until 1999. Now, in between, in 1989, the Berlin Wall collapsed. And that's another one of those things which is easy to underestimate the importance of. I grew up in a divided Germany where there was a West and an East. The idea that I would just as easily be able to take a train and go to Berlin, go to old Eastern cities, and go down to Prague without even needing a passport would have been quite unthinkable in the even in the mid-1980s. But the collapse of the Berlin Wall, the collapse of the Soviet Union, those were all very important building blocks to Europe being the pan-European economy as we know it today. Now, the euro currency, the currency in which two of the futures contracts we're going to talk about today, is actually very, very recent. It was probably launched in the lifetimes of almost all of you listening, really in the early 1990s, but the fixed exchange rate was set in 1991, and the physical notes started coming out at the end of 2001. So by 2002, pretty much everyone I knew already had their starter packs, their banknotes, their coins, and we were dealing in euros and no longer in Deutschmarks, francs, and pesetas. Not that long afterwards, just 10 years later, we were starting to hear the first currency crisis that really had to do with the euro. You had lots of economists saying the euro was a disaster. You know, look at how feta cheese is now no longer made in Greece. It's now made in Denmark. Look at how it's devastated a lot of the economies of Southern Europe. There's a wonderful book by Joseph Stiglitz called, quite simply, The Euro, really talking about the effect of the euro currency on Europe. I highly recommend it for those of you who are interested in Europe's economy this century. But the 2011 to 2012 scenario was known by an acronym PIGS or GYPSY, which stands for Portugal, Ireland, Italy, Greece, and Spain. Those were the countries that had the most severe credit crises that I guess now that interest rates have resolved, most people have forgotten about and moved on to other things. A more recent event that I also want to highlight, given that I am here in Asia, is that Italy became the first EU country to sign on to the Belt and Road Initiative with China. If you think of the Belt and Road as recreating the Silk Road as we knew about it in the Middle Ages, Renaissance Italy was on one end of it, and of course China was on the other end of it. So that was also related, or has been said to be related, to why Italy was one of the first and hardest hit European country with COVID, because there was a lot of trade between China and Milan specifically. So those are events, those are things worth paying attention to, whether you pay attention to Asia and how it impacts Europe, or whether you pay attention to Europe and want to know how does rising China affect Europe. Those are all very, very fascinating stories worth paying attention to, because they may affect how you take long or short positions in something like the Euro stocks. Now, if we look at the numbers, we look at how have these different economies grown or actually declined as a percentage of the world economy in the past 40 years. I find this chart really quite remarkable, and it seems many people I speak to don't quite appreciate how significant this is. The percentage of the world economy that is due to Europe has declined by half in the past 40 years. So you look at that blue line. The European economy used to be about 1/3 of the world economy as recently as 1980. Now it represents only about 15% of the world economy. Now this is, when I say this, I say the European Union. Now if you look down at the bottom, the three biggest European economies, France, Germany, and Italy, have also declined along with it. Now again, this is not, they've declined in absolute terms, they've declined relative to the rest of the world. What this means is that China has grown much, much faster. So China is now a much larger percentage of the world economy, whereas Europe is a smaller percentage of the world economy, even though it's larger than it was. I also wanted to include, for interest, that green line at the bottom showing emerging in Eastern Europe, because this is something where I think us older folks tend not to always immediately think of as Europe. We don't tend to immediately think of Hungary and Poland the same way that we're likely to think of Germany and Belgium. But many of those countries have been members of the European Union since 2004. And their growth is often a driver to many of those companies that you will see in the Euro stocks as well. So very much worth understanding those economies and not overlooking them if you want to understand what are going to be the drivers of returns in indexes like the Euro stocks and the SMI. So that green line basically has been flat. In other words, Eastern Europe has not declined. It's actually been a relatively constant percentage of the global economy and grown at around the same rate as the global economy, while Europe has grown more slowly than the global economy. That's, again, where this chart could say 1,000 words if you want to look into it. Now, I hope that last chart didn't depress any of you, because some of you might say, oh, you know, Europe's economy is a smaller and smaller percentage of the world all the time. Maybe should I just short the Euro stocks against everything else? Well, not so fast. This is one of my favorite charts from a book called Stocks for the Long Run. This is the 5th edition by Jeremy Siegel. And it's a wonderful book, which again, I highly recommend any of you read if you invest in stocks for the long run. What it shows is that the relationship between GDP growth, between economic growth and stock returns is surprisingly negative. And I bet many of you probably didn't expect that. If you look at this chart, for example, you'll see one of the best performing stock markets on the upper chart. The second best performing market is South Africa, which was actually one of the slowest growing. And if you look at what was one of the fastest growing markets, well, Japan for a while, up until 1990, its total returns from 1900 to 2012 weren't so impressive. If you look at emerging markets, it's even more dramatic. You know, China was a very, very fast-growing economy. But if you invested in Chinese stocks from when they first were made available in the early 1990s, you actually wouldn't have made any money. You'd have to be a lot more clever to make money in Chinese stocks. A lot of that, of course, has to do with valuation. So that's why there's a lot of opportunity for traders who can really find you know, good values, overvalued parts of the market, and know how to position portfolios in ways to generate alpha. And that's what I hope to show you with some of the future strategies we're going to be talking about later. Now, diving into these specific indexes, I mentioned that from a non-European perspective, if you're an American pension fund, chances are your decision to allocate to Europe is going to be from a top-down benchmark perspective like MSCI's. You know, so you might start with, say, MSCI World or MSCI All Country World Index, and then you might break it down to EFI, the Europe, Australasia, and Far East, and then break it down to MSCI Europe. Well, Europe, according to both MSCI and FTSE, includes the UK and Switzerland and other non-Eurozone countries. So if you look at MSCI Europe, you'll notice the biggest components in there are, not surprisingly, very large Swiss companies, but then also there's a very large allocation to the UK. Those are going to be broken up in the 3 indexes we're going to be talking about today. If you look at the next column, the EURO STOXX 50, which perhaps like the Dow Jones Industrial Average 30 or the 52 companies in the Hang Seng Index, is a relatively narrow blue chip index, is just meant to be the 50 largest and most liquid companies in the Eurozone. So the EURO STOXX only includes Eurozone economies. That means Netherlands, France, Spain, Germany. It will not include the UK, it will not include Switzerland, it will not include Norway or Denmark or any other non-Eurozone country. And you can see the weights of the Eurozone components, the EURO STOXX 50 components here. ASML, LVMH, SAP are the top 3 components, each from 3 different countries. Now, if we go over to the DAX is an index of 30 stocks, all of which are German. So you'll notice, again, the top 2 components of the EURO STOXX, which are a Dutch company and a French company, are not in the DAX. But the 3rd largest EURO STOXX company, which is a German company, is in the DAX. And if you go down the list, you'll notice that only the German companies in the EURO STOXX are in the DAX. And all the German companies, the top 30 German companies, are in the DAX. Now, if we look at the SMI, you'll notice the SMI is interesting for this presentation because it does not overlap with the EURO STOXX or the DAX. The SMI is a benchmark of Swiss companies. Swiss companies trade in Swiss francs in Switzerland, which is not in the EU, and it's quite a different index. It may at first look like it's a much more lopsided index. You've got 3 companies at the very top, which together represent 50% of the index, but these are blue chip companies that you probably quite well know and probably want a good liquid instrument for going either long or short that component of your portfolio if you have a position in Switzerland. So once again, this particular slide with the disclaimer at the bottom is meant to be just a good snapshot reference of how the EURO STOXX, DAX, and SMI compare with a benchmark like MSCI Europe. Now, going into the individual companies, I am a fundamentalist. I like to know that if I'm buying a stock index, Are the stocks in the index, are they growth companies? Are they value companies? Are they highly profitable companies? Are they dividend paying companies? I like to know things like that. Well, what this chart should show you is that the top component in the Euro Stoxx 50 is a growth company. And that probably shouldn't surprise you if you know what ASML does. ASML is a semiconductor company. Maybe not quite along the same lines as, say, a Taiwan Semiconductor or an AMD or an NVIDIA, but they do, ultraviolet lithography, something which is a fairly hot area right now. And if you look at the bottom chart, you'll see that ASML is trading at a EV to EBIT multiple of 50 times. So it's a relatively expensive, relatively pricey tech company. Is it worth it? Because, if you look across the chart, it consistently is the most profitable of the top 3 companies, even when compared to a software company like SAP. But those who complain, oh, Europe doesn't have any tech giants, it doesn't have like a Google or an Amazon. Well, 2 of these companies are what you probably call tech in some way. I mean, you've got a semiconductor company, the Dutch ASML, and you've got SAP, which is a software company, even if you maybe don't consider it quite as sexy as a Microsoft or a Google in that way. The other one of the top 3 here, of course, is Lvmh. Lvmh is a luxury brands company, Louis Vuitton, Moet Hennessy. They make handbags, they make champagne, they make cognac. And of course, that bid that was made for Tiffany, for example, the idea of Lvmh wanting to be a great global luxury brands titan. So quite a bit of story and fundamental analysis you can do just on those top 3 components of the Euro Stoxx. And of course, everything I've done here, you can go down and do on the other 47 names as well. Now, if you look at the 10-year fundamentals on the SMI components, we'll see that these are not really growth companies in quite the same way. I mean, if you know what these 3 companies are, Nestle, of course, is one of the largest food companies in the world. I'm sure you probably know them for Nescafe and Nespresso and Nestle Quick and Nestle candy bars and all sorts of different baby foods and other products. Probably one of Switzerland's best known companies. The other 2 are pharmaceutical companies in the healthcare sector. Again, all 3, if you look at them, very, very profitable, consistently profitable. Compared with ASML, they're not as expensive on a purely valuation basis. So something to compare side by side. Which ones are your boring dividend stocks? Which ones are your more techie growth stocks by index? If we look at these benchmarks by country, we'll see that Msci Europe, once again, has a large exposure to the UK and Switzerland, but actually, some might be surprised, the largest component in Msci Europe is actually the UK. That's not going to have a place in the other 3 indexes we're looking at, because the Euro Stoxx is actually fairly well balanced between France, Germany, Netherlands, and Italy. The DAX, by comparison, is 100% Germany, and the SMI is 100% Switzerland. So this, again, is meant to be a good, useful reference table on what your main exposures are by country when you're looking at the Euro Stoxx versus the other ones. Now, if you go down further, I mentioned earlier, you're not going to find Sweden in the Euro Stoxx. You're not going to find Denmark. You're not going to find Norway, because none of those are in the Eurozone. I was a little bit surprised going down. There are, at least when I checked, no Austrian or Portuguese companies. But I think for most traders, when you're just looking at the top 50 most liquid companies, these 8 countries represented in the Euro Stoxx are probably pretty good representation of the Eurozone equity market as a whole, which is why I use it. Sector exposure by index. So last time we were talking about country exposure. How do these indexes vary when we look at sector exposure? Now, if you exclude the SMI, which is really kind of almost on its own, the SMI is 40% healthcare and 17% staples. And you can probably guess what those are. Healthcare, we already showed you Roche and Novartis, and staples, most of that is just from Nestle. It's quite a different index than all the other ones. Whereas if you look at MSCI Europe, Euro Stoxx, or DAX, you've got, okay, about 15% financials, about 14% industrials. Yeah, you've got a little more consumer discretionary on the Euro Stoxx because of Lvmh. But these are fairly well diversified across sectors. You don't have things like you see in Canada or Australia, where you have a really lopsided exposure to energy or financials. These are fairly well-balanced, developed market benchmarks as you would expect to see, which is why, again, I sometimes get asked, oh, is Euro Stoxx 50 diversified enough, or do I need Stoxx 600? I usually think Euro Stoxx 50 is enough when I'm just looking at Eurozone because it has most of the main sector exposures. How have these benchmarks performed over the last 20 years? This, again, is just a very quick and dirty 20-year total return chart of the Euro Stoxx, the DAX, and the SMI going back to the year 2000. Now, you might look initially and you'd say, well, okay, what happened here? I see the Euro Stoxx seems to have been the laggard. The DAX and the SMI have done relatively well. One of the biggest laggards, as you might have guessed, is Italy. When you look now, Italy is not a huge component in the Euro Stoxx. It was a much bigger component back in the early 2000s, and it's been one of the worst performing European stock markets pretty much since the 2000s. There are other components you could go by one if you wanted to, but that's the brief answer. You can see that there are periods where one index will outperform the other. The two do tend to move up and down quite a bit day to day, but the idea I want to get in your mind here is spread trades. How might you be looking at, let's say, a long DAX, short Euro Stoxx position, and how might you put those together with micro futures with more precision than you could have with the big futures? Correlation coefficients, also quite important, especially if you want to look at something like portfolio margin on spread trading. It probably doesn't surprise you that all three of these benchmarks are very highly correlated with each other. In fact, the Euro Stoxx and the DAX have a correlation coefficient of 95%. Now, in blue over here, the outlier really is, probably not surprisingly, Switzerland. Switzerland actually even has a relatively low correlation coefficient with Msci Europe, which overlaps with the SMI. But it has a relatively low correlation coefficient with the Euro Stoxx and the DAX. You might say it's high given that there's no overlap, but they are all still in, quote, Europe. And that's what you get if you're looking for some kind of diversification benefit. You want more diversification, look to Asia or look to South America. That's about as much as you're going to get in Europe. So that is the background on the three benchmarks. Now let's go ahead and dive into these new micro futures contracts and see why we should get so excited about them. So if you go to your Interactive Brokers Trader Workstation, you can type in the symbols for any of these that we're going to look at. Now, I'm going to start with the DAX because it's the easiest to spell. Well, actually, SMI is very easy to spell too. Euro Stoxx, you're going to have to type in ESTX50, which is a little bit longer. But if you type in DAX, enter, you're going to get this kind of menu like on the upper left. Now, there is an ETF, but with the ticker DAX, which is going to ask you, do you want to trade that on Smart? Or do you want to trade one of the futures? And over here, you'll see I've highlighted futures. Now, there's also options and warrants and structured products. The DAX is not surprisingly a very popular index. If you select futures, you're going to have to select two more things before you're actually ready to trade. First of all, it's going to ask you the multiplier that you want. The big DAX, if you want to call it that, had a multiplier of 25 euros per index point. Now, if you multiply 25 times 15,000, that's a pretty large contract. That's a lot of euros to be trading on a single contract. That's why, not surprisingly, the big DAX contract is an institutional contract. It's not one that many individual retail traders or even high net worth wealth managers tend to trade regularly on an individual basis. The mini DAX, again, don't confuse the mini DAX with the MDAX, completely different things. The mini DAX is simply a smaller DAX contract with 5 euros per index point. Now, this new micro DAX that we're going to be trading is actually going to give you one more option in this multiplier box. So when you type in DAX futures, you're going to have to go down and select multiplier 1. What that means is that you are going to be trading a futures contract with only 1 euro per point. So when the index is 14,500, it means you're going to be trading 14,500 euros worth of the index rather than 5 times or 25 times as much. That's what the micro futures mean. And if you are trading 14,000 euros per trade rather than 75,000 euros per trade or 200,000 euros per trade, this is quite exciting because it makes the contracts much more bite-sized and much more easy to trade. So that's what I have here on the highlight. you're going to need to choose both a multiplier and you're going to need to choose a contract month. Now, unless you're trading calendar spreads, usually what I do is I select this infinity one, this DAX continuous contract, because then in my trader's workstation, it'll automatically roll it for me to whichever is the front month the most active. So right now, if I want to trade the DAX, it's going to pull up the June for me. That's the one that's going to be the most liquid, the most traded. And I'll just have to remember at the end of May to roll out of my June and get into September. That's something that futures traders are very, very used to. That's one difference between futures trading and ETF trading, is the need to roll. Now, because I had to pull up these screenshots before the micro launched, I am going to be getting on Monday and trying to trade my first micro contracts then. I was showing sample screenshots using the mini DAX contracts because that's all I had available. This just gives you an idea of what it looks like next after I've clicked multiplier of 5, June, contract. And in this case, I said here, I want to sell one DAX future. And I went ahead and I put in a limit price of 14,800. So in other words, I'm willing to wait for the index to go up a little bit more before it executes my sell order. I want to use this to take profits without actually selling any of my shares. And you can see down here at that time, the multiplier was 5. So 5 times 14,800 is 74,000 euros notional per contract. With the micro, it's only going to be 14,800, multiplier of 1. I pay a commission of 75 euro cents for this trade, so actually very, very cheap given how much I'm trading. And I've got an initial margin requirement here of 17,000, roughly 17,000 euros for a 74,000 euro position. So for those of you who like leverage, or for those of you who want to be able to short without having to borrow and put up the whole 74,000 euros, that gives you an idea of what's involved. Now, if I'm going to be trading the Euro Stocks instead, this was the full-size Euro Stocks futures contract. So with Euro Stocks, there's no mini. There's the Euro Stocks, and then it's going straight to the micro. With the Euro Stocks futures, it was 10 euros per index point, and the new micro is just 1 euro per index point. And if you see where the Euro Stocks is trading at right now, that's very exciting, because 3,800, that means that one contract is only about 3,800 euros worth of index. So if you want to trade 4,000, 8,000, 12,000 euros, it's much, much, much more granular than the big contracts ever were, and much more competitive with an ETF side by side if you want to compare them that way. Once again, this trader screen gives you a sample of what trading one big Euro Stocks futures contract looks like. In order to know what the micro contract is going to look like, just divide all the numbers by 10. And last but not least, I wanted to show a sample trade with the SMI, just to mix things up. The last two were sell one contract. This is buy one contract. Again, I'm not making a specific investment recommendation. I just want to show you what the screens look like. So over here, I'm showing you one big SMI contract where I would buy one contract at 10,800 index points. The big contracts are 10 Swiss francs per point. The new ones are 1 Swiss franc per point. You will see again here all these numbers you could divide by 10. For 108,000 Swiss francs future contract, I would need about 17,000 of margin in my account. You can go ahead and do the math, what leverage ratio that applies. By the way, I believe these numbers, margin limits on the right, are all in US dollars, because I did this in a US dollar account. That will be important when we talk later about the currency optional strategy. How do the margin limits differ if we're going to buy versus if we're going to sell? Now, we did mention something called portfolio margining, but it's also you have to figure, one of the strategies I'm going to talk about is using these contracts to sell short. One of the best things is, let's say, for example, you're worried that the market is going to fall. You're worried the market's going to go down. You have a lot of stocks, and you want to sell some futures contracts just so that if the market goes down, you'll make some money on your futures contracts to offset. The margin requirements for buying a future and selling a future are not always going to be the same, for the simple reason that on selling a futures contract, you can lose a lot more money than you can make when you buy a futures contract. When you buy a futures contract, it is assumed that the index can only go to 0. It's not going to go below 0. We found out last year the hard way that oil prices can actually go below zero. Oil prices can go negative. We've never seen negative stock prices before. That would be new. But I, in this case, showed VSTOXX futures as an example, because a VSTOXX is an index that can more than double. It can triple or quadruple very, very quickly, as we saw last March, which is why the margin limits for selling a VSTOXX future is different than the margin limit for buying a VSTOXX future. That, again, is another screenshot I'm leaving there for you. Now on to the 4 actionable strategies. Actionable strategy number 1, the leverage long position. So let's say, for example, I have some money, but I want to have more exposure to the Euro stocks than I have money, money in my account. So let's say, for example, I want to get exposure to 3,800 euros worth of the 50 stocks in the Euro Stoxx 50. If I wanted to buy 100 shares of a Euro Stoxx ETF, I would have to take that 3,800 euros out of my pocket and buy the ETF with cash or with margin. Whereas if I have the margin requirement, which in this case is going to be much less than this, it could be probably 700, 800 euros. If I just have 800 euros in my margin account, I can buy one contract, which will give me long exposure to 3,800 euros worth of the Euro stocks. Now, you can see, of course, that could be very, very dangerous, but it's also in a very efficient way if maybe I'm not pushing my limits. Maybe if I want to lever 1.5 to 1, 2 to 1, it's a very efficient way for me to get levered up exposure to my Euro stocks position without having to pay retail margin rates, without having to take the extra cash out of my pocket, without having to pay Lombard loans. In fact, you're probably going to get the best financing rate that way than you will any other way. Another attractive thing is, let's say you're not based in a European Union country. Let's say you're based here in Asia, and you want to buy the Euro stocks. Well, all the dividends and everything are all priced into the futures contract. I don't have to worry about things like financing costs or borrow costs or withholding taxes on dividends. All of those are priced into the futures contract. So in many ways, the futures contract is a much cleaner and simpler way of accessing this index. There's also no management fee, although the way that it's made up is that you typically have to roll these futures contracts every 3 to 6 months. You can't really very easily trade a 2025 futures contract now for a 5-year position. Like I showed you, I would buy the June or I'd buy the September, and when the contract comes up, I'm going to need to sell out of it and roll. So effectively, instead of paying a management fee, I'm paying trading costs to maintain this position. But again, for some investors, this can be a very efficient way of maintaining a consistent long position to an index. Now, a version of this, which I call my strategy 1B, is the overlay strategy. And there are several versions of this I've done in my career. A simplest one is, let's say I've got 20,000 euros. And let's say instead of wanting to divide it up between stocks and bonds, let's say I want to invest that 20,000 euros in both stocks and bonds. I want to have 100% in both. And those of you who know the effect of balancing stocks and bonds, they tend to move in opposite directions. This is a way of getting the returns of both and managing my risk while using my capital a lot more efficiently. So how can I do this? Well, there's a few ways. Here I'm assuming that I put all 20,000 euros in bonds, and I use that as margin in order to buy 5 micro Euro Stoxx futures contracts. So what's that going to give me? The 5 micro contracts is going to give me exposure to 19,000 euros worth of stocks, and I still have my 20,000 euros worth of bonds, so I get to have my cake and eat it too at the same time. The fractional margins allow you to overlap them at pretty much institutional rates. So I'm not paying retail margin rates. I'm not paying Lombard rates to borrow them. And if you want to juice this up even more, by the way, don't forget Eurex has a Bund future, an OAT future, a BTP future, if you want to get your bond exposure that way. You can really push it and get quite creative with this if you so wish. But plain and simple, all stocks, all bonds, this is one way of doing it. And again, I do want to have the warning, because the red warning at the bottom may not be enough. Don't press your margin limits, because you can lose a heck of a lot of money in futures contracts very quickly if you're not careful. Strategy number 2. So the first 2 strategies were long strategies. I want to buy futures contracts to get access to the Euro stocks or my index of choice. But let's say, for example, I've bought some stocks that I really like. I've bought maybe 10 or so European stocks that I really believe, I want to hold on to, I want to collect their dividends. But I'm worried that the market's a little bit hot right now. Market's a little bit high. I'm worried the market's going to decline. So I'm going to hedge by selling some futures contracts. So let's just say, for example, I don't want to sell all my position. I just want to, micromanage it. Every Euro Stocks 50 futures contract I sell is the same as selling short 3,800 euros worth of shares. And I'll only have to put the margin requirement for that 3,800. I won't have to borrow the shares. I won't have to pay margin interest rates. And for every point that the index declines, so if the index goes from 3,800 to 3,700, I make 100 euros. If the index keeps going up, presumably my stocks will go up as well, but I'll lose 100 euros on that contract as well. Once again, I will have to roll that contract every 3 to 6 months. And remember, once you get into shorting, you have the risk of unlimited loss because in the theory, the index could go to infinity. Now, if it did, your shares could go to infinity, but you could have picked some duds and this index could go like crazy. And that's a risk to watch out for. So that's strategy number 2. You own really good stocks and you sell the index as a hedge. Strategy number 3 is spread trades. The nice thing about this is you're taking opposite positions in 2 different indexes. The example that I want to give here, or you can do it vice versa. Let's say you want to buy 4 Euro stocks versus selling 1 DAX. And the reason I say that is that those are roughly the sizes that it takes to have roughly a neutral net exposure. Because remember, 1 Euro Stocks micro is 3,800 euros, 1 micro DAX is 14,800. This position would be, let's say, I think the rest of Europe is going to do well, and I think Germany is going to devalue, or I could do it the other way around. Again, very, very efficient. No shorting, no retail margin rates, no borrowing. There is also worth mentioning because Borsa Italiana launched their micro FIB, their micro FTSE MIB future recently as well. If you are able to do the trading on both exchanges, you could also take a position on, say, Germany versus Italy or Italy versus the rest of Europe. Now, if you do this trade versus the SMI, don't forget that the SMI is denominated in Swiss francs. So you will introduce an FX component as well. That shouldn't be rocket science. And I do have to admit, of all the brokerage platforms I use, Interactive Brokers does make it easier than any of the other ones I've used. So as mentioned, using futures for both sides of a spread trade can be very clean, very efficient, very easy. And once again, just you'll have to roll every 3 to 6 months. Last but not least of my 4 main strategies is just efficient, what I call currency optional foreign access. Let's say, for example, I'm a US dollar-based investor, or any other foreign investor. I'm not based in euros. I don't have my money in euros. Ordinarily, if I wanted to buy the Euro Stocks 50, let's say if I wanted to buy an ETF, I'd have to convert my 3,800 euros I'd have to convert my dollars into 3,800 euros by the ETF. And then let's say the euro goes down, even if the index goes up, well, the decline in the currency could offset all my profits. Let's say I just want to have a position on the Euro stocks going up without being worried about how the euro versus the US dollar is going to move. Well, the nice thing is when I buy a Euro stocks futures contract, I'm not converting my dollars over into 3,800 euros. It's only my margin, which is settling my P&L in euros on a daily basis, only at the margin. So in a way, if you think about what's my position, if I've got 5,000 US dollars, and then I go buy a Euro Stocks futures contract, and then the index goes up 100 points, even if the euro goes down, I've still made 100 euros of profits, and the effect of the euro going down only affects my 100 euro profit, not the full 3,800 euros. So that's a question I get quite often whenever it comes to currency hedging, is that currency hedging in a way is almost the default if you're a foreign investor buying a Euro stocks or an SMI future. So again, if you understand futures, this is pretty obvious, but this is something worth understanding if you want to look at physical versus synthetic exposure to any foreign market index. And by the way, this is true when you're trading the Nikkei or the TSX or any other index you might do as well. But Euro stocks is a fairly major one for there. Now, I hope I've excited you about these micro contracts because I'm very much looking forward to using them on Monday. But one thing I will also say, hopefully to get you excited in other webinars, is for another day, these indexes that we mentioned also have liquid options. And I would love to do another webinar talking entirely on option strategies on the Eurex, on the Euro stocks for example. But that will have to wait another day because we've spent quite a bit of time just talking about the index and these future strategies. So for now, I will go ahead and leave it at that. I will leave up this slide with my contact information and the contact information of Chi Chao Feng, who is Eugen's contact based here in Hong Kong. He is also on WeChat, and he will be able to answer your questions both in English and in Chinese if you'd like to ask any questions about any of these three Eurex products. Eugen, I believe, has shared his contacts as well, but I think now let's go ahead and open it to questions.
Thank you very much, Tariq. That's an excellent presentation, great demonstration of what happens in Trader Workstation when you're trading these products. Did get a great question from Jacob. He asked about the data subscriptions required for the contracts. He's only seeing delayed pricing on his TWS. So Jacob, and to anybody else, I'm having the same problem in my TWS. I'm seeing the data for the VSTOXX contract, but not on the micros. So I'm going to try and find out what's happened and what data subscription is necessary to see that pricing. If anybody wants to follow up on that, send me an email, webinars@interactivebrokers.com, and I will get back to you. I've got a question out right now to the team for that. So let's move on to Jacob's second question. Will options be available for use on these mini contracts to effectively manage risk? Eugen, you there?
Yeah, I'm there. Yes, I mean, as outlined by Tariq, we have the equity index options on the EURO STOXX, and we have the equity index options on the ODAX, and we have the equity index options on the SMI, and both are related to the three future contracts. So yes, you can trade the options against the future contracts, either against the existing contracts, or against the mini contract, or against the micro contract. So yes. When you need to consider the ratio, of course, because, for example, the EURO STOXX option has a 10 euro multiplier, and the EURO STOXX future, the regular one, has also a 10 euro per index point, and yeah, the micro future has a 1 euro. So that needs to be considered, but in general, the options can be traded against each other. Yes.
And Eugen, while you're speaking, could you just go over the trading hours for the Eurex minis, please?
Mm-hmm. That's a good question. We have extended trading hours since 2 years. So DAX and EURO STOXX micros will be available for 21 hours per day. We start trading on Sunday night, or yeah, Monday morning in Singapore, Singapore time 8 a.m. and yeah, 21 hours. And then we have a short break, and then we start again the next morning, Tuesday, at 8 a.m. Singapore time. I mean, that's 1 a.m. in Frankfurt. That is 6 p.m. in Chicago. So we are 21 hours a day available, 5 days a week.
There's just no stopping you guys, is there, Eugen?
Yeah, I mean, that's a standard in the industry. So, but I mean, we're a global company, so we just follow the sun. So it's like a handover from region to region.
Right.
And maybe one thing to mention, that the 21 hours is for DAX and for EURO STOXX. The SMI will be only available in European and US hours.
You mentioned right at the outset, Eugen, that the Eurex was home to the contracts with the highest open interest. Which ones are they out of interest? And a follow-up question on that, because going back 20 years, I was personally trading German government bonds because they were that liquid. Eddie's asking the question, are there any plans for a micro Bund contract?
That's a good question. I mean, we're, of course, as I said, Eurex is always a trailblazer in new things. So we are continuously working on improvement. For the fixed income side, I cannot say anything. We start right now with the equity side, but I mean, I can take this as another point to think about. But for now, it's nothing planned on the fixed income side.
But do you know, or maybe you don't know, but which contract has the highest open interest globally?
The highest open interest, that's a good question. I need to go into my
Oh, that's okay. I thought you might just have that off the top of your head as a statistic. That's no problem. We'll talk about that offline. I was curious. It used to be the Bund, right? And I don't know if volume has migrated and open interest has migrated to the shorter end of the curve.
Out of the top of my head, I would say it's either the Bund as a classical institutional product, or the Euro STOXX. One of those must be the one with the highest one. But I can deliver exact figures.
Yep. Folks, you've got a couple more seconds to put questions into the chat panel for Tariq or for Eugene. For I call him Eugene, for Eugen. Before we wrap up today's session, don't forget we did record today's session. The recording will be available to you in a couple of hours' time, since we're finishing shortly. Look out for that in your inbox. Tariq, do you have any final reflections before we wrap up?
Not really. I'm surprised that all the questions were just technical ones. No one was asking me like my views on Europe blowing up or anything like that. Usually those are the fun ones. So I'm sure we'll be able to follow up offline with anyone who wants to pick that up.
There is a question for you about something you mentioned a moment ago. When are you going to do the option link presentation? Asked Jacob, regarding the futures contracts.
Great question. I've been wanting to do an options webinar for a while now, and I'll probably have to do several of them because I'll probably be doing one for Asia, one for Europe, and so on like that. So I'll probably coordinate with Eugen on doing one specifically on EURO STOXX for European hours. And yeah, we'll get back to you. I mean, Andrew will be sending that out to the list as well. So.
Okay, and one's coming in again from Eddie for Eugen. What's behind the decision to reduce the tick size for the Euro STOXX 50 next June from 1 to 0.5 point?
That's a very good question, and this question or this decision has been not made like from one day to the other. I mean, we are voicing the market on a regular basis. And we have been talking to market participants on a global level for the last 2 years. And yeah, we got approached by some part of the market that say it would make sense to reduce the tick size for the Euro STOXX to have a tick, because these types of investors say that the trading costs for them will be lower than, as said. I mean, this decision has been not made from one day to the other. This was a 2-year process, actually. And we were just following the feedback, and we were just following the voice of the market. And that's why at the end of the day, we made the decision on the reduction of the tick size for the big Euro STOXX as of June. For the micro Euro STOXX, we already have the reduced tick size as of launch next week.
Excellent. Looks like there are no more questions. We've just gone over the hour mark, so that would be a good time to wrap up. And it just remains for me to thank Eugen Moore from Chicago with the Eurex, representing the North American index products. Thank you very much for joining us today, Eugen, and especially to Tariq Dennison over at GFM in Hong Kong. Thank you both. I'll let you both say farewell to the audience, and we'll look forward to having you back on the Interactive Brokers webinar platform soon. Thanks, gentlemen.
Thank you very much, Andrew. Thank you very much, audience. Great having you.
And let's kick off Monday morning. Thank you.
All right. Thanks, guys. Thanks to everybody for joining us. Bye for now.